The first rule in investment is don't lose. And the second rule in investment is don't forget the first rule, and that's all the rules there are.
Hello everyone, this is Marquis Harding with the Red Cliff Investor Show. Now welcome back. Today we are going to look at cat or caterpillar. Let's begin with a clear picture evaluation. So we see the revenue growth has gone up about 20 to 24.5%. Profit growth has gone up 34%. Profit margin has almost gone up 100%. And again, these are from 5 years ago. Gross margin has gone up almost 71%. Net income growth has gone up 101%. Net margin has gone up 92.67%. Free cash flow has gone up 39.74 or 40%. Price to free cash flow, they are fairly valued or undervalued. At 17.62%. Price to free cash flow is simply taking cash for their sales, the revenue, and compare it to the cash to the free cash flow. And you weigh it and see if it's fairly valued or overvalued. When I say fairly valued, I mean undervalued. Fairly valued is valued correctly. Fairly undervalued would be something like under 15. Between like 16 to 20 would be fairly valued. And 21 through like 25 would be a little bit overvalued, but that's manageable. But anything over 25, that's way overvalued. Their free cash flow yield is perfect at 55. Sorry, not 55. 5. I don't know why I'm saying like that. 5.77% or almost 6% free cash flow. Sorry. It's a little chilly where I'm at. But however, take the total debt and divide it by the free cash flow, it'll take them about 7.7 years to pay off their debt. They're doing a fantastic job in their shares outstanding, because Uncle Paul says the shares outstanding will be a silent killer of your stock. They're buying back 40 million shares, and they're giving you value. They're adding value to your holdings by 7.35%. However, the return on invested capital is at 8.1% or 8.10%. Here's Warren Buffett's favorite measure of valuation is return on equity. It's at 24.3%. That's fantastic. So let's look at the DCF model. But before that, let's look at forecasts. So we look at the stock forecast, and there's 36 stock analysts and reviewing the stock. We have a high of 294 with an average of 240 and a low of 162. So quite a bit of spread, but they still say it's a buy. With 12 saying hold, like hold it, I believe. 13 says continue to buy more. 7 says really buy more. 3 says sell it, and 1 says you need to sell it now. They saying the revenue should be at 57.89, with actually a 13.57% increase or revenue growth. Then next year it should be at 62.63, which is about 8.19 or 8.2% revenue growth. Well, let's look at my discount cash flow model. My discount cash flow model says the fair value is 151.6. or $151.60. For me to fall in this range, for this fair value, it needs to fall about 18%. But let's go back to the clear picture. Let's look at it. So as of right now, selling at 185.49. For me, it needs to fall to $151.60. If I add an additional, or not additional, margin of safety of 65%, it needs to be at 98.54, roughly a 22.35% discount. So, but that's my fair value. You may have a different fair value, but let's do the gut check score. So we have gut check score of 1, 2, 3, 4, 5, 6. Sorry, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. We have 1 over 11. Oops, what's going on? Yeah. 11. So 1, 6, 27, 22. If I can do this correctly. So that's my analysis of cat or caterpillar. Take care, folks. Bye.